Hello and welcome to Money Tree. I'm Joe and today I'd like to talk about the principles of value investing. Have fun. The principles of value investing. Warren Buffett said once, value investing is simple, but not easy, and that's exactly it. It is simple because you only have to follow a few basic rules to be successful in the long run. It is not easy because many people do not succeed in sticking to these basic rules in concrete stress situations. The most important principles of value investing that one should take to heart are: Number 1. Patience. Patience is the investor's top virtue, because once you have purchased shares, you have to put in the time and wait until other investors also realize the value of the shares and invest. Once they also buy, prices will rise because prices are based on supply and demand. For this reason, Joel Greenblatt advises, if you buy cheap, you have to have the patience and wait for the market to agree with you. Number 2. Control your emotions. We humans tend to perceive negative things more intensively than positive ones. This also applies to the stock market, where people quickly panic when prices fall and sell too early when prices rise. This loss aversion leads to many investors achieving significantly lower returns than would be possible. For this reason, it is necessary for investors to keep their emotions under control and act purely rationally. If you are not willing to hold a stock for 10 years, you should not own it for 10 minutes. Warren Buffett. Number 3. Don't buy stocks, take a stake in a company. Value investors should think of their investments not as stocks subject to the daily fluctuations of the market, but as partial ownership of the underlying companies. Seth Klarman. If you want to be successful in the stock market, you have to do your homework first. You don't buy shares based on price movements or on a whim because everyone is doing it. You buy shares in a company based on its business results. You should become a partner of the company. You support the company through difficult times as well as through profitable ones, and thus you profit from its development. The decisive factor for a successful investment is not the short-term price movements, but the long-term company performance, because the price will reflect the performance over time. Number 4. Buy low. If you are a good merchant, you know that the profit is in the purchase. The lower the purchase price, the higher the profit and the lower the risk of being able to resell the goods at a good price. From a value investing point of view, the price is low if the intrinsic value of a share is higher than the current stock market price. In the search for the right company, one must pay the most attention and invest the most time. The selection of the stock is A&O. You have to study the annual reports, determine the intrinsic value of the company with the help of key figures, and only then compare this intrinsic value with the current stock market price. If the share is quoted with a safety margin of 30% to 50% below the intrinsic value, then one should buy. Buy low, sell never. Warren Buffett. Number 5. Keep it simple instead of complicated. Value investing does not require complicated mathematical formulas, but rather relies on common sense and, most importantly, patience. In value investing, the motto is, the simpler and more boring a business model is, the more interesting it is for the value investor. That means buying shares in solid, established companies run by honest and capable management, and doing so at a price below intrinsic value, i.e., not yet reflecting the company's profit potential. Make it simple, not complicated. Pick companies with understandable business models that will last. Warren Buffett. Number 6. Never speculate on credit. Value-based investing is designed for the medium to long term and not for taking short-term fluctuations in the stock market. Thus, investing on credit is not crowned with success. Let's take an example. One buys a share on credit, which 7% interest per year must be paid, and holds this share then for years in its depot. The share must rise per year then by 7%, in order to repay only the credit interest. Also, you lose your freedom of action by a credit financing, namely to do nothing, and likewise you lose a basic rule of value investing, to have patience, to let the money work for you. With credit financing, the money even works against you. The risk-reward ratio turns out negative. Borrowed money has no place in the investor toolbox. Anything can happen in the markets at any time. Warren Buffett. Number 7. Never invest outside your competence. In the stock market, investors should avoid mistakes as much as possible, because the fewer mistakes you make, the higher the return that the investment made will generate. For this reason, You should invest from the beginning in shares that you also understand and can also estimate. Furthermore, you are dependent on the advice of others in things of which you have no idea, and you rob yourself of the possibility to make informed decisions. Also, the possibility is very high that you burn your fingers and sink a lot of money unnecessarily. Stay within your circle of competence and don't invest in things you don't know anything about, because the risk of making bad decisions increases exponentially otherwise. Warren Buffett. If you like the video so far, subscribe to the channel and leave a like. And now the video continues. Number 8. Look for untouchable companies. Warren Buffett and other value investors look for companies with nearly untouchable brand names and market position. This is about competitive advantages of brands and products, the economic moat, companies that dominate the market, such as Coca-Cola. Buffett refers to these types of companies as fortresses, castles. Companies in this category are companies whose products or services have no alternative, are needed and wanted by customers. The best idea is to look at a stock as ownership in a company and judge the consistent quality of its business by its competitive advantage. Charlie Munger. Number 9. You don't do good business with bad people. In order to be able to evaluate a company correctly, investors must be able to rely on the figures presented, be they annual financial statements, balance sheets, etc. This is the case if the company is managed by people of excellent character. But if there are doubts about reliability, one must also cast doubt on all figures and give such a company a wide berth. We don't want to associate with managers who don't have admirable skills, no matter how attractive the prospects of their company are. We have never succeeded in doing good business with a bad person. Warren Buffett. Number 10. Price slumps are buying opportunities. For an investor, share price slumps are both a blessing and a curse. A curse, because a double-digit percentage drop in the share price represents a severe reduction in assets, but a blessing, because now all interested investors can get into the company or invest even more. Because if outstanding companies stumble in the short term, the price losses represent real buying opportunities, but only for investors with a medium-term investment horizon. Because then it is a matter of taking advantage of the panic of others and stock up on favorable shares. Be fearful when others are greedy. Be greedy when others are fearful. Warren Buffett. Number 11. The power of compound interest. The decisive criterion for the success of an investment is the return achieved. This return can come from interest, from dividends, or from price gains. Price gains can simply be let run on. Dividends as well as interest flow directly into an account and can be consumed for other things or reinvested. The most sensible thing to do is to reinvest the dividends directly so that they also generate a return. This is called compound interest, and investors should take advantage of it because compound interest is the driving force that turns small amounts into large fortunes. Compound interest is the eighth wonder of the world. Those who understand it make money from it, everyone else pays for it. Albert Einstein. If you liked the video and want more, subscribe to the channel and leave a like. See you.